We're looking at 3 strong REITs that look undervalued for a buy now near their 52-week lows. As usual, we'll look through the historical performance of each one. We'll look at their dividend safety. We'll run through their financial metrics. We'll also pull out a few key topics from each of their latest investor presentations, drawing out on specific points. And we'll also run them through our stock valuation model, getting to the intrinsic value, finding our acceptable buy price, given our investor margin of safety, and look towards Wall Street to see what they're forecasting over the next 12 months. So the first undervalued REIT that we're talking about today is MAA, Mid-America Apartment Communities. Now they are down 27% over the last year. They're trading pretty much near their 52-week lows, with a yield just under 5% and a P to FFO of just under 14. If you've been holding this REIT over the last 10 years, you would be up 86%. Bear in mind, it doesn't include those dividends reinvested, and we see their all-time high December 27 at $229. So let's take a look at MAA's latest investor presentation and just draw out a few key topics here. Now, for those that don't know, they have around 102,000 apartment units. They have compounded annually over the last 10 years at 9.7%. And one thing that we don't talk about a lot on this channel, which I really like to see, is when the average executive tenure has been quite a lot. When people who are in management have a lot of experience, it does really help take this company forward. And for MAA, it is 21 years. Now, a lot of people may say if it is bad management, then it's better to get rid of them. But typically, when management have been in for such a long time, it does look like overall their performance is strong. We'll touch upon some of these details when looking at the financial metrics, but we can see some nice growth, one on the dividend paid, as well as the core funds from operation per share growth year on year as well. Now, one thing I wanted to draw out here for those that aren't too fully aware in terms of their diversification and balance, they do have 276 same-store communities. As you can see, a lot of them, in fact the majority, are on the east side of the US. And we can see they are diversified within sub-markets as well. We have the inner loop, suburban satellite city, as well as the downtown. And we can see in terms of property types, there is some diversification there. So MAA, multifamily residential REIT, let's take a look at the financial metrics. Dividend safety score 97, very safe, one of the highest scores obtainable. Market cap 14.5 billion, it is a large cap company. Key metrics then for those that see a recession inbound, well, they maintained it during 07-09 recession, plus 1.2% recession sales, above the average growth, which was around negative 12% for the S&P, but they had a near S&P return, negative 51% versus the S&P's negative 55%. Dividend growth 5% in December 23, not the greatest, but you are getting an above inflation increase. Remember, inflation over the last 40 years in the US was 4%, 9%, which is nice to note. Last 20 years, you are at least getting an inflationary increase year on year, and with the starting yield, that isn't too bad to note. They've also been increasing those dividends for the last 13 years. So let's take a look at dividend yield theory. As always, it states a company is undervalued when the current yield sits above the 5-year average. 4.67 versus 3.19, a sign here of severe undervaluation. Do keep in mind, though, we're not looking at any of these models in isolation. We will conclude towards the end, and this is one of the highest yields it has offered over the last 5 years. We also note another sign of undervaluation with the forward P to AFFO 15.4 below the 5-year average of 21.4. However, we can see here the real estate sector P to AFFO is slightly lower at 13.6. As always, for REITs, we do ignore the free cash flow payout, even though we prefer it for the majority of companies. It is a lot more volatile, hence the adjusted FFO, funds from operation, is a lot more relevant. Below 90% is what we aim for. Very nice to see for MAA. It is below that consistently year on year. 68% in 23, 72% expected in 2024. Well, adjusted funds from operations share, it isn't consistent increases year on year, but over the longer period pretty much doubled, which is very nice to see. 824 in 2023, although we do know in 2024 it is expected to stay fairly flat at that 815 level. Sales growth now for REITs, we want to see steady moderate growth, 5 to 10%. So we can see that nearly every single year. In fact, some years very strong double-digit growth. 2023, the latest period, coming in at 6%. It is within that target we aim for. And the adjusted funds from operation per share growth, which you could argue is more important, we do look for some strong growth here, and we can see for MAA over the last 3 years looking very strong. Again, we just want to draw out that 2024, like we mentioned above, is expected to drop slightly. In terms of sales then, for those that like to see the numbers, around 1 billion of sales in 2014, 2.2 in 2023. Very typical now what we're seeing here, REITs diluting your position over the longer term, 75 million in 2014, 117 in 2023. What I would point out here, if you do look at the channel, other videos that we do look at and review in terms of realty income, Vici Properties, they would dilute your position as a shareholder at a much faster rate than MAA. In fact, they are one of those that doesn't dilute your position at a very quick rate, which is always great to see. ROIC, it is one of my 7 golden dividend metrics when identifying undervalued companies and strong companies. I want to see 10% or more. That is if they're a normal company. If we're looking specifically at REITs, 3 to 5%. Gives me faith that essentially management are able to effectively allocate their capital or part of it. Last 2 years above that, very strong at 6%, so that is very nice to see. And for those that want to see the other 7 golden dividend metrics, if you do subscribe to the free weekly newsletter, clicking on the pinned comment below, every week we talk about a different topic. The latest week we ran through some insider buying and insider selling, different companies where management were buying and selling shares. And we've also talked about undervalued companies with strong upsides and running through our golden dividend metrics to find undervalued companies. Completely free. You can gain access to that by clicking on the pinned comment below. Moving on then to the operating margin, nice to note it has been increasing over the period. They are increasing their efficiency and at a healthy rate, low 30s over the last 2 years. Net debt to EBITDA, finally then, earnings before interest, tax, depreciation, amortization. Remember, that shows us 1, the balance sheet strength, 2, the dividend safety. We want to see for REITs below 5.5. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. 3.59, very nice for MAA. 3.59, pretty much flat in 2024 as well. No worries noted here then on the balance sheet or that dividend safety. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And on the channel, we do run through deep dives. We're going through every single one of these models. Today's episode, we're going to get straight to the intrinsic value. And for Mid-America Apartments, we get a value of $169. With the current price around 126, we start off with a margin of safety of 10%, which we use if we believe it meets 3 criteria. Wide moat, strong financial metrics, good forward-looking data, and we keep going essentially until it's near the current trading value at a 15% margin of safety and acceptable buy up to 144, at 20% up to 135, 25% 126, pretty much at the current value we see with our estimates and judgments a 25% margin of safety. In terms of Wall Street, well, they have a price target of 147, so they see upside of 17% for MAA, so they do believe this to be a strong buy. As always, when we go through these stocks, do let me know your thoughts in the comments below, whether or not you are adding to any of these or they are on your watch list waiting for a certain price. We then move on to the second REIT, which is FCPT, Four Corners Property Trust. Now, over the last 10 years, we can see they are up around 82.4%. Over the last year, however, similar to the majority of REITs and the sector, they have been hammered down 19%. They're trading towards the mid to lower end of the 52-week range, a yield pretty much at 6% forward-looking, and a P to FFO of 14.23. Now, before we get into those financial metrics, let's take a look at their latest investor presentation, which came in November 2023. Looking at their latest results, Q3 2023, we can see 99.8% occupied, over 1,130 leases, and we can see here that is quite important, 8-year average lease term remaining, and 6.9% expire before 2027, because there was a lot of this issues with REITs and how they had a lot of debt, although a lot of people didn't realize that most of these didn't mature for quite some time, where we would expect the interest rates over this period to come down lower. On a geographical basis, a little bit different to MAA, which was a little bit more skewed to the east coast of the US. We can see their geographically diverse portfolio, although over 10% is in Texas, as we can see, but they do have a lot of properties scattered all over the US, as we can see from this graph. Then when we take a look at the actual clients, the brands that they have, 314 of their leases, so 37%, come from Olive Garden, 21% other restaurants, they have 10% Longhorn Steakhouse, and as we can see, there are also a few others, and it's probably best to look at this pie chart. Now, just one last thing that I wanted to point out, they do have diversified industries. The auto industry, in fact, makes up 9% of their annual base rent, and when we look at the medical REIT, they takes up around 7%. So let's take a look at Four Corners Property Trust. Let's look at the numbers. Dividend safety score then 46, borderline safe. We'll touch upon that shortly. Market cap 2 billion, a mid-cap company. Key recessionary metrics, well, there's none available. They didn't pay a dividend in that period, and there's none of that due to the fact that they did actually spin off from Darden Restaurants not too long ago. Dividend growth 1.5% in November 2023, 6% over the last 5 years, which is a lot better. A little bit disappointing in November, in my opinion, and they have been increasing these dividends for the last 7 years. So in terms of dividend yield theory, we see that massive sign of undervaluation, 5.95 versus 4.74. Likewise on the forward P to AFFO, 13.7 versus the 5-year average of 17.1. And we can see it is pretty much in line with the real estate sector P to AFFO. So let's look at the adjusted funds from operation payout. Pretty consistent, it is below 90%. The last 3 years at 82%, 2024 expected as well around that 81%. So no worries around paying that dividend. In terms of the adjusted funds from operation, we do see consistent increases year on year for the large part. 2023 and 2024 expected increases again. So when we look at it percentage-wise, we can see, whilst not the largest growing adjusted funds from operation, it is still moving in the right direction. And the sales growth, as we can see here, over the last 3 to 4 years, looking very strong. 2023, double digits, 11%. So numerically, for those that like to see the numbers, 2013, 17 million to 243. Again, I would say when looking from 2016, they don't really dilute your position at a very quick rate that you would see from the majority of REITs. So that is a positive sign, but it is one that can change from year to year. ROIC, now whilst it has been decreasing from 2016, I would note that still over the last 3 years, 6% is very solid for a real estate investment trust. Operating margin, very strong. Again, it is decreasing, so that is one thing I would keep an eye on. Nonetheless, 54% in 2023 is very healthy. Finally, the net debt to EBITDA, which probably does correlate to that dividend, which sits at borderline safe. 2023 at 6.01 is above the 5.5 levels we want to see, although in more positive news for 2024, it is expected to come lower to 5.19. So let's take a look at the valuation of FCPT, and as always, if you want, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or on your watch list by clicking on the pinned comment below. Margin of safety at 10%, then a buy up to $26. 15% up to $24.27, and at 20% it isn't quite there yet. So for Four Corners, we see between 15 to 20% as a margin of safety. In terms of Wall Street, well, their price target is $27, so likewise to MAA, they do see this as a buy with upside of 16% over this period. But as always, do your own due diligence before going ahead. We then move on to the third stock, which is GLPI, Gaming and Leisure Properties, down 14% over the last year, and over the last 10 years, up 22%. Again, trading towards the 52-week lows with a yield of 6.4% and a P to FFO forward-looking of 12.5. Now, before we jump into the metrics, let's take a look at their latest investor presentation, again from November 2023. Some nice facts to show here. They have 61 properties across 18 different states, and they do have a significant number of hotel rooms as well. One thing that they are very proud of, they are the most geographically diverse owner of gaming assets in the country, with the largest number of gaming assets owned as well. Very, very strong as well. They collected 100% of their rents during COVID, and around 88% of their rent comes from premier publicly traded gaming companies such as Penn, BYD, CZR, and BALY. As we can see here from this map, they are very geographically diverse, although some could argue not as diverse as maybe they had made it out seem to be from the beginning. So in terms of their financial metrics, dividend safety 41, borderline safe, market cap 12 billion, a large cap company. No recessionary metrics, so we can't use that. 1.4% increase to the dividend in August 23, 2% over the last 5 years, so fairly slow, not exactly what we really want to see. but they have been increasing those dividends for the last 2 years. In terms of dividend yield theory, we have that sign of undervaluation, 6.38 versus 6.02, but we can see the forward P8 to AFFO nearly in line with the 5-year average, although we do note it is lower than the real estate of 13.6. So looking at the AFFO payout ratio, we see a number of years where it was above 100%, which is a red flag indicator, although it is nice to note that from 2020, so the last 3 years, it is below 90%. 2024 expected 78% is also a positive. Adjusted funds from operation, it has been increasing over the longer term. Nice to see 2023, 2024 as well, growth to that adjusted funds per share. We can also see the percentages here year on year, and when we look at the sales growth, maybe not the fastest growing REIT that we've analysed on this channel, but 2023 double digit is nice to note. And over the longer term, it's gone from 240 million to 1.41 billion. Shares outstanding then pretty much more than doubled, 116 million in 2013 to 263 in 2023. ROIC for a REIT looking very positive, 10% in 2023, 9% in the previous year, 8% in 2021. So it has also been increasing, but this is very, very strong in my own opinion. And it's nice to note that the margin not only very strong in the current year, but it has also been increasing, showing that operational efficiency by management. Net debt to EBITDA, again, we can see this is closely linked to that dividend safety. 4.8 in 2023 is nice to note. 4.61 in 2024. So it is below that 5.5. So no real worries, but it could be something just to keep an eye on to ensure it doesn't go above that 5.5 level. So what about the essential valuation? Let's take a look. And in today's episode for GLPI, the intrinsic value comes to $52. Margin of safety then at 10%, it is a buy up to 47, 15% up to 44, so not too far off, around $8 shy. So we'd say that this has around a 15% margin of safety based on our estimates and analysis. In terms of Wall Street and their forecast, well, they see a price target of $53, upside of 15%. So they do, similarly to the previous two, believe this to be a buy. The first stock we had MAA with upside of 17%. The second one, Four Corners Properties Trust, that at upside of 16%. And GLPI, no coincidence whatsoever, but upside of 15%. As always, let me know your thoughts on these REITs. Did any of these interest you? Are adding of these on your watch list? Or maybe you have been adding these in the last few weeks. As always, if you enjoyed this REIT content, smash that like button, hit the subscribe and bell button. Let me know if you want more of the similar content. And for now, see you later.